And hello traders, and welcome to another video. So this is the third part of the PDF guide, and in this part we are going to first talk about liquidity. So I suppose that everyone here knows what liquidity is, but for the people who are joining first time and they're not familiar with the concepts, we are going to briefly just explain what liquidity as a concept is. So basically, how do I like to explain it is like this, guys. There is certain conspiracy theory, literally, in trading, that all of the retail patterns, all the retail education basically that we first learn when we start trading, like, double top, double bottoms, trend line, support and resistance, that was basically made for us on purpose so we can lose money. Okay, so basically the big boys have made up education, like in terms of patterns and whatnot, actually to generate liquidity. Okay, so I'm gonna put it simply like this. If you guys want to sell an asset, there always need to be another buyer on the other side. So that's called basically liquidity. So for every buyer needs to be a seller, and for every seller there needs to be a buyer. So for example, in Forex, there's tons of liquidity, and you usually do not have problems with liquidity. Okay, for example, with NFTs, it's a little bit different. Maybe let's say you saw a project that you actually liked. You liked, how they did the photos and everything, but not. You found it good. You thought that it's gonna double or triple your investment. You bought a couple of photos. You minted a couple of NFTs, and then the project failed. And you're gonna see that it is really, really, really hard to sell that photo right now, sell that NFT, because there's not a lot of liquidity. Okay, so I just want to give you a quick example, so you can understand better what liquidity is. So basically, if you want to buy an asset, there always needs to be a seller, and if you want to sell an asset, there always needs to be someone who is willing to buy on that specific price. So for us, when we trade, we do not have problems really with liquidity. We can open and close positions whenever we want. Okay, but we are also trading with smaller amounts of capital. So the theory basically is that large financial institutions, hedge funds, and big boys, whales, they do not have small capital. So they're trading for like millions and billions of dollars, and when they want to open buy or sell position, they need tons of liquidity in order to do that. So for example, if they want to buy for like $10 million, I'm just giving you an example, there needs to be on other side, there needs to be someone willing to sell them for that specific price, on that specific price. So there is where this theory of liquidity comes in. So the theory is that basically they're manipulating us through retail patterns like trend line, double tops, resistance supports, because they know that we have a bunch of stop losses, in those areas. So for example, you're gonna see, we see here equal highs liquidity, and we have a double top. So there are traders who are selling on this second top, right? And they are opening their sell positions right here. And we know that here there is tons of liquidity right now. So tons of stop losses are sitting above this area. Okay, so the traders who are selling at a double top are putting their stop loss right above these highs, right? And right now institutions know that, and if they want to open those big positions for millions and millions of dollars, they're gonna need first to generate liquidity. So the point is, the price is gonna continue up, take all of them stop losses, and then go in the right direction. So they basically need to generate liquidity in order to execute certain positions. So basically this is where theory comes in place. You know, the big boys have made up retail education as we know it, because you know they want to generate liquidity and take your money. So yeah, that's basically that conspiracy theory. Everybody knows it, guys. Everybody who ever started trading first has introduced with double tops, double bottoms. Everybody has done it. So basically that's like a small conspiracy theory in this industry about liquidity. So basically right now that you know what liquidity is, we can discuss what types of liquidity there is. And yeah, we're going to discuss a little bit more about it. So first of all, guys, we here we can see equal highs liquidity. That's a double top and double bottom liquidity, guys. And we have trend line liquidity also. You know, people buying on the trend line. Below our trend line, there is liquidity. Above here, people are selling. Above it, there's liquidity. And we have support and resistance liquidity. You know, so we have support here. Price gonna take that liquidity. So here you have a photo of examples before, and here I made examples after. So what usually happens? So you're gonna have a double top, people are gonna have their stop losses here, but it's gonna go a little bit down, and then boom, it's gonna take their stop losses. Same here for same example here for double top, double bottom. Then you have resistance, support, trend line, resistance, and support liquidity. There are people who are buying here. Below, they have a lot of stop losses, so prices most likely going to take their stop losses. Then you have a resistance and support liquidity as well. So here we're going to start breaking down every concept in terms of charts. Okay, so everything that you see here, we basically did a chart example for that as well. So as you guys can see here, we have a double top liquidity. Price came back to a little bit below, boom, took out that liquidity. So you can combine actual liquidity when you're trading as well. So you know you can use it the same. You can use it as the same concept as imbalance. So for direction, okay. So maybe you have a demand zone here. Let's say you have a demand zone here, and you want to buy here because you know price is most likely going to take that liquidity. So you can use liquidity as advantage for direction, okay. Also, you can use it for confluence when you're trading. Maybe let's say you saw this change of character and you wanted to sell here. You want to sell here on this supply zone right here. Maybe now because you have liquidity above, you do not want to sell because price is most likely going to take out that liquidity and thus take out your stop loss. Okay, so you can use liquidity in both ways, either for direction as an extra confluence when you're trading, or negative confluence as well if you have liquidity above, below your entry, etc, etc. So again, guys, in these videos I'm only touching bases about what liquidity is, showing you a couple of examples, and I'm not really showing you everything in detail. I just want to make sure that you guys understand that, you know. So basically what I'm talking here is 10% of what we have in hybrid FX community. Hybrid FX community, everything is already broken down, done for you. Chart examples, every little single thing. You know, we are talking about the trades and how can you mix up liquidity and trade so the liquidity is in your advantage and everything. So in hybrid FX community, we have already everything in advance. So again, this is just a basic things, showcasing examples of liquidity, what liquidity is. I'm not going into more details and showing you entries, exits, how to use it, when to use it properly, etc, etc. I just want to let you know that, so everything is clear. So double top liquidity, guys, double bottom liquidity as well. Here you can stop, read the description here. We have here support, trend line support. There are a lot of people who are buying, here on the trend line, boom, price just takes that liquidity. You have also resistance, trend line resistance liquidity. There are people who are selling on this trend line, and price just boom, takes that liquidity. So you have also a resistance zone. You see that, we have liquidity above, we have liquidity below. Usually what price tends to do here is take out resistance right here, and then boom, take out support right here, sweeps liquidity to the upside, then sweeps liquidity to the downside. This is why I do not like to trade in range, because this price is just being manipulative all the time. The same example here, just for support zone, takes out support. That's basically it. Okay, nothing really special. I'm just showcasing some examples and types of liquidity, and I did explain what liquidity is, but on how to use it, when to use it, trade examples and everything, you would need to join the Hybrid FX community. So guys, here also as well, I have made price action ultimate price action cheat sheet. Okay, so this is really important in terms of price action. So on the left, you're going to see that first we have ascending price action. You need to understand and you need to recognize different kinds of price action, because you see a lot of people are trying to buy because they see ascending price action and they think this is an uptrend, but that's really wrong. Ascending price action is when we break these previous highs with weak break of structure, and this ascending price action is not an uptrend. This is not a bullish trend. This is not a bullish structure. This is price action showing us that it is tired to continue to the upside, and we have weakness to the upside, no momentum to the upside. And this is what usually happens, guys. We have change of character, reversal, we execute our trades here to take this liquidity down below, because remember, there are traders who are buying on this support, trendline support basically. And then we have descending price action. It's basically the same thing, but vice versa. Okay, we have weak break of structure to the downside. Price doesn't have enough momentum to continue to the downside. We have liquidity above because there are people who are selling on this resistance right here. And this is what usually happens. Okay, price makes this change of character, reacts, and then boom, takes out all of this liquidity. Then you have corrective price action. This is where you want to stay away from the market, avoid it, not trying to trade a lot. You should be focusing more on protecting your capital, not risking it. I do not like to trade in corrective price action because I cannot have a really big risk reward trades. Okay, as I mentioned in the previous couple of videos, the point of you maximizing your profits is really important. So you win big and let your profits run, and when you lose small and cut losses short. And when you're trading corrective price action, guys, price is just ranging, going up down, profit loss, and you cannot actually have those high risk reward trades. And this is why I avoid really, when price action is in corrective market, when price action is consolidating, I really do not like to trade. And this is what usually happens. So you're going to have a sweep to the upside, price is going to take out this liquidity, and then you're going to have a sweep to the downside, price is going to take this liquidity as well. You can use this concept though in your advantage. Maybe you have impulse correction, impulse pattern here, and then you have equilibrium zone, maybe equilibrium supply zone right here, and then you have this use this as inducement, and then price tags you in, and then boom, continues to downside. So you have impulse correction, you have equilibrium, you have inducement, you have your block, and then you have also direction, because what happens. So you can combine all those things. And this is what I told you. This is not exactly the strategy that I'm teaching you here. This is basically getting to know price action, getting familiar with smart money concepts, showing you what is good, what is not, so you can actually combine those things in your training. And I would like to see, after you have done with the PDF, after you have watched all the videos, I would like to see you going into the charts, and I would like you sharing your charts with the community, so we can really see how your trading has improved after you have learned all of those concepts that we are teaching. So it'd be really, really good to see how your strategy and your trading has improved now that you know all of those concepts. So study it, test it out, and send your charts so we can see them, and how your trading has improved after you have applied those concepts. So this is example, guys, of bullish structure. Okay, so this is structure that it's bullish. you have impulsive break of highs or previous highs. So, price is indicating momentum and price is reacting to these order blocks. Usually what happens is we have a continuation. So next time when you're looking to get involved in a continuation trade, you see price action going to the upside and you want to buy, try to execute when there is a bullish structure, when we're breaking highs impulsively and we're reacting to order blocks, instead of using this. So this is not good. This is a standing price action indicating weakness, and this is bullish structure indicating strength. So you want to get involved in buy opportunities right here, and you want to basically wait for sell opportunities here. So there's a big difference, and a lot of people do not understand it. So I do hope after watching all of this that you're going to get to know what price action is what price action actually, and not confuse both of them. So bullish structure, when we have bullish break of structure, multiple reactions, usually continuation, and again the same thing as for the bearish structure, price breaking the lows impulsively, reacting, and usually we have a continuation. So right here, guys, for every, same as in liquidity, for every example right here, I have made a chart example as well. Okay, so this is a standing price action. So you see price action moving to the upside. We have weak break of structure. How do we break this high? We break it with a wick, immediately retrace. How do we break this high? Break it, immediately retrace. How do we break this high? We break it with weakness, immediately retraced. And what happens? Boom, massive bearish candle to the downside, change of character. First here, then confirmation here, standing price action to the upside, touching the order block, and then continue to fill all of this liquidity to the downside, and also this imbalance as well. And also this liquidity as well. I didn't mark it, but there's liquidity as well here. So, you see here how you can use all of those concepts and combine them together. So first we have learned what, weak break of structure is. And then we have learned what a standing price action is. Okay. And then you have a standing price action, a weak break of structure, and there's a weakness to the upside. Then you have shifting momentum. And we have learned what high probability order block is. When you have impulsive break of structure, when you have momentum, when you have strong close, when you have, high probability order block, when you have imbalance as well. This is high probability order block. And then okay, this is high probability order block. Then what is high probability change of character. When price breaks this low impulsively with no weakness left behind. Then you also know what type of pullback you want to see. So you want to see ascending pullback indicating weakness, not volatility indicating strength to the upside. You do not want to go against momentum. You want to take advantage of momentum. And then you're also combining concepts, liquidity and imbalance. So guys, you have liquidity here. People who are looking for buy opportunities here to buy on the trend line. Then you have imbalance as a direction as well. You have more liquidity right here. You're using all those concepts that you have learned throughout those videos. So you make your charts and you make your trades better. Okay, that's basically it. So you just need to study the PDF, study the videos, and go apply those concepts in the charts. Okay, so basically I have done it for you right now. I show you everything basically that we have learned, and this is example of high probability trade that we would consider this a high probability trade because all of those concepts we have them combined. Okay, so yeah, let's move on. This is the descending price action example, price moving to the downside. Again, indicating weakness, then boom, shift in momentum. Same thing basically, guys. Then you have corrective price action. This is, where you should stay away from the market because, again, you have liquidity below, you have liquidity above. Price is going to take and sweep liquidity from below, and then it's going to sweep liquidity from above. Again, you can apply these concepts for, your benefit. If you have a strong supply zone that you want to, use for reaction maybe, and then you have a reaction, boom, here, and price has swept liquidity to the downside, it's most likely going to sweep liquidity from the upside. And maybe you have imbalance and liquidity right here as well to the upside, and then you have a supply demand zone here, and you use it for a reaction, and then you have a breakout from this ascending. Maybe price comes back with leaving imbalance behind, and then comes back in this descending. And then descending also indicates weakness. It reacts to your supply. You have a breakout in positive change of character. Then you have a pullback, and then you boom, continue to the upside, to fill this imbalance, and to fill this liquidity. So you need to play with those concepts, be a little bit creative, and yeah, that's basically it, guys. You have everything basically that you need. It's not the strategy. Okay, again, I'm telling you, it's not the strategy. It's only concepts that you can apply to make your trading better. Okay, it's not the strategy, actual strategy. In hybrid community, we have rules for everything. We don't just execute blindly. We have rules for execution. We have rules for management. We have every little thing in hybrid strategy. But again, these are only the concepts that are actually going to improve your trading tremendously. I'm sure of that. And this is why I would really, really like so you can share your charts community and tell us how you have improved your charting, your skills, and overall trading in general. So we have here bullish structure, guys. So this is where you want to get involved in the uptrend. You see price action is breaking the highs impulsively, breaking the highs impulsively, breaking the highs impulsively. Look at this momentum, strong candle close, breaking the highs impulsively. This is where you want to get involved in the market, right? So this is where you want to get involved in buying opportunities. You have reaction here, you have reaction here. You see prices reacting. Maybe a good buy would be here. Price action again, coming back to the downside in descending price action, generating liquidity. We also have liquidity here as well. We have tons of liquidity here sitting above. There are people who are selling here on double tops or whatever. So we have descending price action, weakness to the downside, and then you have boom, trade entry here that you can actually take long positions here to take this liquidity, and you have a confirmation that price is in uptrend. Or another entry you have here on this order block. You see you have impulse, correction, impulse, strong candle close, nice bullish momentum, imbalance left behind. Only bad thing about this would be what? Aggressive pullback, right? So aggressive pullback going against momentum, but if you have again 5 positive confluences and 1 negative one, it's still good to consider trading. Again, guys, I told you, in order to trade with logic and not with emotions, you need to write down all the things. So on the left side, you're going to write down all the positive confluences about the trade, and on the right side, you're going to write down all the negative confluences about the trade, and you can make your trading decisions. So basically showcasing when trend is present, when bullish structure is present, and when you want actually to get involved in buy opportunities here. So the same thing, guys, for the downside. This is descending, not descending, this is bearish structure, price reacting multiple times from supply zones, putting lower lows in the market, breaking the lows impulsively. There is trend involved. You want to get involved right here. Okay, and that's basically it, guys. That's basically it. So here you're gonna see what do we offer, everything in community. I don't think that this is everything. We have even more things. You can click here to join. It's gonna open up our website. You can choose the packages you want to take, and yeah, you can join us. So all of this basically is let's say 10 or 20% of what we have offer in hybrid FX community. So this is basically nothing compared to what we are teaching in community. Again, I just briefly explain certain concepts, but there is no strategy here. So if you want to learn hybrid and how hybrid works and everything, join the community, and yeah, it would be really great to see you there. So yeah, that's basically it about this, guys. I hope you enjoyed it, hope you liked it, hope you learned something new. And guys, again, remember, if you have any questions, if you have any concerns, if something is not clear to you, always remember that you can ask us anything anytime you want. Okay, just shoot us a message in Discord community. We are gonna be more than happy to reply to you. Okay, guys, and with that, yeah, that's pretty much it. Again, study the PDF, study the videos, go apply it on your charts, and send your charts in the community so we can review it. We can tell you what should be improved, in your strategy, in your trading, etc., etc. So we are here for you. Yeah, that's pretty much it, guys. I wish everyone a successful and profitable trading career, and yeah, see you in the next video. Bye bye.